Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Greenbrier Companies Inc. annual report. The Greenbrier Companies Inc. offers a diverse range of businesses and services across three segments: manufacturing, maintenance services, and leasing and management services. Manufacturing segment designs and manufactures various types of railroad freight car equipment, offers covered hopper cars, gondolas, open-top hoppers, boxcars, tank cars, and intermodal railcars. Maintenance services segment provides wheel services, including reconditioning and new axle machining, operates a railcar maintenance network, manufactures and reconditions various railcar parts, such as cushioning units, couplers, and side frames. Leasing and management services segment offers operating leases and per diem leases for approximately 15,500 railcars. Provides management services, including plus railcar maintenance management, plus railcar accounting services, plus fleet management and logistics, plus administration, plus railcar remarketing. The recent drop in Greenbrier Companies Inc. GBX stock price can be attributed to several key factors. The primary driver of this decline was the company's disappointing fiscal 2026 guidance, which fell short of analyst expectations. Specifically, Greenbrier projected earnings and revenue that were significantly lower than consensus estimates. Additionally, the company missed Q4 2025 revenue estimates, despite reporting better-than-expected adjusted earnings per share. This weakness in revenue growth and missed estimates reinforced concerns about demand and near-term revenue visibility. Furthermore, declining sales volumes and operating margin in Q3 2025 indicated challenges in sales growth and operational efficiency. The negative market reaction to these mixed financial results led to analyst downgrades and a shift in investor confidence regarding Greenbrier's future performance. While the company had a record year for earnings and EBITDA in fiscal 2025, the forward-looking guidance for fiscal 2026 overshadowed these positive aspects, resulting in a significant stock price decline of approximately -29.14% over the past year. The primary drivers of revenue growth or decline for the company can be summarized into several key areas. Firstly, changes in contract assets and liabilities have a significant impact on revenue growth or decline. This includes accounts receivable, inventories, deferred revenue, and trade payables. Additionally, leasing and fleet management activities, maintenance revenue, and multi-year contracts also contribute to revenue fluctuations. The company's reliance on a few large customers is another factor that affects revenue growth or decline. Furthermore, changes in equipment on operating leases, debt, foreign exchange contracts, and interest rate swap contracts can also impact revenue. Overall, the company's revenue growth or decline is influenced by a combination of these factors, which have contributed to the observed trends of revenue decline from 2023 to 2025. Net income and profit margins. A shift in favor of growth. The financial summary reveals a significant shift in net income and profit margins for the company. Between 2024 and 2025, net income increased by $44 million, or 27.5%, with a notable jump from $172.7 million to $213.1 million. This growth can be attributed to cost-saving measures and increased efficiency, which led to a decrease in operating expenses. Profit margins also saw an upward trend, rising from 15.8% in 2024 to 18.7% in 2025. The effective tax rate decreased, implying an increase in profit margins. However, there was a slight dip in manufacturing margin, while leasing and fleet management margin showed improvement. The growth in net income can be attributed to revenue growth, which contributed significantly to the increase. Industry and entity-specific indicators also impacted estimated future cash flows of Greenbrier Astra Rail BV, affecting profit margins. Overall, the company's financial performance indicates a positive trend, with increased net income and improved profit margins. The company's financial performance indicates a strong ability to generate cash from its core operations. With a net cash provided by operating activities of $266 million, the company demonstrates a healthy and sustainable financial position. This positive operating cash flow is a key indicator of the company's financial health and stability, suggesting that it has sufficient resources to meet its obligations and invest in future growth opportunities. The company's debt level has undergone significant changes over the past few years. Initially, it increased from $1,764.5 billion to $399.4 billion between 2023 and 2024. However, in 2025, the debt level decreased by $33.9 million from August 31, 2024 to August 31, 2025. This indicates a fluctuation in the company's debt level. Regarding interest expenses, there have been both decreases and increases over time. In 2023, interest expenses decreased significantly from $100.8 million to $75.7 million. However, between 2024 and 2025, net interest expenses decreased by 4%, and interest and other expense, net decreased by 25%. On the other hand, in 2025, interest expense increased from $13.4 million in 2024 to $15.5 million in 2025. These changes suggest that the company's interest expenses have been subject to fluctuations over time. The company's financial performance was strong across various segments and regions in 2025. Notably, North America, Europe, and South America all performed well, indicating a broad-based growth. Within the company's business segments, manufacturing and leasing and fleet management saw significant increases in earnings from operations, with respective jumps of $18.8 million and $21.6 million over the previous year. These results suggest that the company's diversified approach to markets and operations is yielding positive outcomes. Management is optimistic about the company's outlook, citing its integrated business model as a key differentiator and a major contributor to customer satisfaction and loyalty. They plan to continue investing in research and development, expanding services and financing alternatives, and prioritizing safety and employee engagement. The company expects to face challenges in recruiting and retaining skilled labor due to collective bargaining agreements with unions, but management is confident that they can navigate these headwinds while executing their multi-year strategy. They are focused on increasing recurring revenue, expanding aggregate gross margin, and raising return on invested capital, despite the impact of changing trade policies and geopolitical uncertainty. Management also highlighted the company's strong financial performance in 2025, with increased margins, net earnings, and cash provided by operating activities. They believe that existing funds and cash generated from operations will be sufficient to fund debt repayments, working capital needs, planned capital expenditures, additional investments in unconsolidated affiliates, and dividends for the next 12 months. Overall, management is committed to fostering an inclusive environment, promoting collaboration and professional growth across the team, and continuing to execute on their strategy despite potential headwinds. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In recent years, it has paid out significant amounts in dividends, totaling $114.1 million over 3 years. Additionally, the company has also been actively buying back shares under an authorized program, demonstrating its commitment to returning value to its investors. Concerns about inventory buildup and supply chain disruption are evident throughout the financial summary. Disruptions in material supply, rail traffic, equipment failures, and limited suppliers for certain components pose significant threats to business operations. The war in Ukraine, higher energy costs, and decreased availability of steel and materials have already caused disruptions in transportation and supply chains. Additionally, macroeconomic instability, foreign regulations, embargoes, quotas, or tariffs could further exacerbate these issues. Natural disasters, pandemics, terrorism, or severe weather conditions also pose a risk to business continuity. The increasing inventory levels on pages 48, 54, and 67 indicate potential concerns about inventory buildup, while the lack of information on supply chain disruptions in these sections suggests that this issue may be more pressing elsewhere in the summary. That concludes the financial summary for Greenbrier Companies Inc. Feel free to comment below, and I will be happy to answer them when possible.